Hi, and welcome to today's Engaging for Missouri webinar. I'm Alice Roach from the Division of Applied Social Sciences at the University of Missouri, and I'll be your host today. With each of these 30-minute webinars, we intend to share research-based insights that leaders like you can apply in your own work to benefit and strengthen the state's agriculture and food system, hospitality sector, and communities. Today, Dr. Pat Westhoff will share highlights from FAPRI's 2021 U.S. Agricultural Market Outlook. Before I invite Pat to begin, I want to share a few housekeeping items. First, we'll close today's presentation with a question and answer session. Those of you who connected today via your computer may submit your questions in the chat screen. To open the chat, just click the chat icon that you see at the bottom of your Zoom window. If you joined today by phone, then you may email me your questions at roacham@missouri.edu. Second, all attendees are muted and may not start their video. Third, if you encounter any technical problems during today's webinar, then please let me know by either submitting a comment in the chat screen, or you can also send me an email at roacham@missouri.edu, and I'll do my best to help you troubleshoot. And then last, we will make a recording of today's presentation available. You can look for an email from Zoom that shares more about where you can access that recording in about a day from now. You can also find an archive of all of our previous Engaging for Missouri webinars on our Division of Applied Social Sciences YouTube channel. So with that, we'll transition to the topic of today's webinar, which is titled Highlights from the New FAPRI Outlook for the Farm Economy. Presenting is Dr. Pat Westhoff, who directs MU's Food and Agricultural Policy Research Institute, otherwise known as FAPRI. So thank you, Pat, for presenting today. If you could please unmute your microphone and start your video, then we can begin today's presentation.
Thanks a lot, Alice, for the opportunity today, and happy St. Patrick's Day, everybody. We'll talk through some of the highlights from our new Outlook that was released last Friday. We had a chance on Friday of last week to talk to people on Capitol Hill and USDA about this Outlook, and I'm going to share with you some of the same slides we used with those audiences on Friday. Hang on just a sec. So about the market outlook. So we've been doing this every year since the mid-1980s, believe it or not. So it's been a long tradition at FAPRI. We have this year's timeline was that we began the effort back in November of 2020, developing a preliminary baseline, getting together all of our analysts and their models to come up with what we thought was a good shot of what the future might look like for the next 10 years, given that information available then. That was then reviewed in December of 2020, but normally do that review in DC, but this year, of course, because of COVID requirements, we needed to do that by a virtual set of workshops. Then in January, we came back, did it all over again based on the comments received in December, as well as other new information that came out from USDA reports in January. That was followed up by some stochastic work. We looked at how the world might unfold different ways, depending on the weather, depending on other factors that make the ag markets inherently uncertain. Summarized all those results and put together a report, and that was issued again last Friday. That report's available at our website, www.fapri.missouri.edu. We have a lot of people involved in this effort. So here at the University of Missouri, we work on U.S. crop and biofuel markets, government costs, farm income, world livestock, dairy, and biofuel markets with the team listed there. I've got a great team of folks here with me at FAPRI. We also work with the Ag Market and Policy group here at MU, that's Scott Brown, Daniel Madison, on U.S. livestock and dairy markets, and work with people at partner institutions at Texas A&M, University of Nevada, Reno, Texas Tech, and University of Arkansas on particular aspects of the outlook for the farm economy. This baseline is based on what we knew about policies and markets in January 2021. So by definition, it does not include anything that happened since that time. It does, however, reflect USDA's final estimates for 2020 crop production, other reports, other information was available about the middle of January. Current policies are generally assumed to continue. So that incorporates the 2018 Farm Bill with its provisions assumed to continue indefinitely. It incorporates relief programs that were approved up through December of 2020, including the $20 per acre payments that were part of the appropriations bill approved at that time. It does not, however, include the reconciliation bill that was just approved by Congress here a couple weeks ago, nor does it include our guesses about what future policy might be, whether we're talking about climate change policy or any other number of areas where there might be good reasons to expect policies will change in the future. We don't try to second guess those, but rather we just keep current policies in place in our baseline effort. Then that baseline can then serve as a point of reference when we look at alternatives. Let me jump straight into the results here, and the story I should say a bit. And this largely follows the sequence of the slides that appear in the briefing book itself. So if you get a copy of our Ag Market Outlook, you'll find these same slides are reproduced there. So the first one, again, is a reminder of what COVID did to at least livestock and meat markets. So there's two lines in this chart. The green line is going to represent the price received by farmers for the animal products that they sell. And the blue line is going to be the price that consumers pay for meats, poultry, fish, and eggs. So it's not too hard to find the beginning of the outbreak in this chart. So in March and April of 2020, we saw lots of problems in packing plants, lots of problems in processing, all sorts of products, and getting it transported to final consumers. So the result was that packing plants were not willing to pay as much for live animals, driving down the price paid to farmers for what they sold. At the same time, that cost to consumers went up. So we saw this continue for several months. It was only after about, say, June or July of last year that things started moving back towards a more normal situation. It wasn't really until the late fall that we kind of got these two lines back in order with each other, back to more normal circumstances. But note that even at the very end, we still had producer prices lower than they've been in the months before the pandemic hit. Of course, the pandemic is not the only thing that affects agricultural markets. If you talked to us last August, we would have given you a very, very dismal outlook for the farm economy at that time. But a lot has happened since that time, most of it positive news, at least for crop producers. Uh, Surprisingly, part of that good news is that crops weren't as big last year as they had been expected to be. We had about 1.1 billion bushels less corn being produced in the final estimates versus estimates that have been made in the August of 2020. And likewise, a similar reduction in the expected size of the soybean crop of 290 million bushels relative to earlier estimates. So if you think about that, there's less supplies on hand that will tend to drive up prices. Normally, higher prices will mean less consumption, and that's indeed what we saw on the domestic use side. That domestic use of both corn and soybeans is now expected to be less than had been projected last summer. But what is surprising is that exports, instead of falling with higher prices, have actually increased. We're seeing more exports of corn and of soybeans, primarily to China because of strong demand in the Chinese market. So that combination of less production and more exports results in far lower ending stocks than had been anticipated previously, and those lower stocks translated to much higher prices. The price of corn paid to farmers back in August of 2020 was $3.12 a bushel. The last month for which we have a market level price for paid to farmers, it was well over $4.30 a bushel, and futures prices, of course, are far higher than that today. The other big news item, of course, that happened throughout 2020, and especially in the final months of the year, is we made very large payments to producers, record payments, far exceeding anything we'd ever done previously. The combination of the market facilitation program that was put in place in 2018 that made its final payments in 2020, the coronavirus food assistance program that made two rounds of very large payments in 2020, with at least one more round of payments still coming up here in 2021. And finally, the Paycheck Protection Program. That combination gave us $46 billion of government payments last year, more than $20 billion above the previous record. Talking about the crop sector outlook, let's talk about ethanol first of all. With the effects of the virus on people's driving habits, less gasoline was used in 2020, especially in the spring. That drop in gasoline use because of less driving meant there was also less ethanol used, because the vast majority of ethanol being used in this country today is being used in 10% blends with gasoline. In this chart, the total motor gasoline use is on the left, off the left-hand axis in green, and the total amount of ethanol being used is off the right-hand axis in blue. Note that I've deliberately got the scale set up so that the 1 billion gallons of ethanol on the right-hand axis corresponds to 10 billion gallons of fuel use on the left-hand axis. So if we're using strictly 10% blends, you'd expect these two lines to be pretty much on top of each other. And that's what we've seen basically between about 2014 and 2019. With less driving in 2020, we saw less ethanol use as well as less gasoline use. We're expecting recovery in driving to occur this year with more gasoline use associated with that. And we're projecting at least a little bit of an uptick in gasoline usage again in 2022. But note that even in for the duration of this projection period, we never get gasoline use back up to the level of 2019. Part of that's because of more fuel efficient cars in general. It's also because of the advent of electric vehicles. If we were to have a more widespread adoption of electric vehicles more quickly, you could actually expect to see that green line tailing off over time. The blue line representing the ethanol domestic use, you see, is a little bit above the green line when you correct for the scale factor here. So it implies we've got at least a little bit of E15, E85 going on in the projection period being pushed by provisions of the renewable fuel standard. How that evolves in the future will depend on the RFS itself, how that is administered by this and future administrations, and of course, what happens to the price of gasoline and a wide range of other factors as well. On the export side of things for crops, again, we've seen incredibly strong exports for both corn and soybeans this year, probably record levels of exports of both those commodities during the current marketing year, which is not what we would have guessed maybe 6 or 8 months ago. So that very strong outlook has helped drive up prices. We do think that we'll probably have just a slight dip perhaps in exports in the 21-22 marketing year, the crop we harvest this fall, mostly because of a limited availability of supplies. We don't have enough supplies to really have exports be much higher than this as we've drawn down stocks, especially for soybeans this year. Longer term, of course, but how this will evolve will depend on China, will depend on global economic growth, supplies in competing countries, supplies in importing countries, and our ability to handle this amount of exports through our current grain handling system. One of our puzzles that we face, of course, has been China throughout all this, and again, changes in the Chinese market, changes in Chinese policy could upend whatever projections we make. One thing we're having a tough time understanding ourselves is the relationship between meat production in China and feed use as reported by USDA. So the meat production is largely based on internal Chinese production estimates. And you can see the very sharp reduction occurred in production of pork in particular in 2019 and 2020. That was caused by African swine fever, a disease that caused widespread culling of hog inventories in China, and sharply reduced their ability to produce pork. They had been looking like they turned the corner a few months ago, and that sow numbers were increasing. Production was starting to increase as well, and our baseline was prepared in January, and we thought that was likely to be the path forward. They would see some increases in pork production in the next several years, get total meat production in China back close to the 2015 level by the 2025 period or so. But note that the feed use chart looks a bit different, right? So you'd probably expect in normal circumstances that these two charts would have a similar pattern to them. But one part of what might be going on is that when the ASF crisis struck, it caused people to change the types of feeds that they use in China. So instead of using a lot of household waste and things like that to supplement the diet of hogs and other livestock, they've gone to more commercial rations, look more like a typical U.S. ration. So it's pushed up the amount of corn and soybean meal included in feed rations in China. But frankly, there's also just a lot of question about the data itself, and we're not really sure we can trust the data coming out of China on meat production. And we don't really have a good estimate what Chinese stocks are of corn and other crops too, all of which could impact the future in a very major way. So put those pieces together, again, we're looking at probably an increase in acreage for both corn and soybeans in 2021. Part of the story is not just higher prices, but also what we hope is going to be return to more normal weather conditions. As I look out my window this morning and see how it's been raining, I worry about this a bit. But we had 2 years in a row of substandard planting time conditions for planting. The flooding we all know about in 2019, but still far from ideal conditions last year as well, which combined with low prices limited total acreage. So we've got our projection of 91.3 million acres of corn, 90.4 million acres of soybeans. That's relatively close to USDA's estimates on soybeans in particular, just a little bit below USDA's estimate in the case of corn. On the livestock side, again, we mentioned this already, but because of the COVID crisis last year, we saw big changes in the margins between what farmers got for the livestock that they sold versus what people had to pay for the meat that they purchased. So in the second quarter of 2020, we had incredibly high margins between wholesale beef prices and live cattle prices, and pork prices likewise the same sort of situation. You can see things got back closer to normal the last couple quarters of the year, but we still were probably a bit higher than normal on our margins in the final months of 2020. Part of that's because we have put in place more protections in packing plants to make it safer for the folks who work there, and that involves some costs that are likely to continue in the future. One positive thing on the meat side has been like in the case of crops, a strong demand from China. Because of the SF outbreak, China had less pork. They didn't make all of it by importing more, but they made a part of it by increasing their imports, not just from the United States, but from Europe and from other suppliers of pork to international markets. That offset some reduced sales to leave some other markets, partly because of ASF or because of COVID effects, but also because of just challenges with higher prices and the ability to move products around the world last year. Going forward, of course, how this evolves will be a big deal. If China is able to increase its pork production in 2021 and beyond, that may reduce their demand for pork imports to some degree. However, I would note that since we put these baseline projections together, there have been some recent reports of new ASF outbreaks in China that may or may not have a significant effect on their ability to produce pork in the months and years to come. On the dairy side of things, we had big swings in milk prices in 2020 because of the COVID crisis. We had this horrible situation in the spring where some dairy farmers were literally having to dump milk because they couldn't find anybody willing to take it off their hands. At the same time, grocery stores didn't have milk on the shelves. We figured some of those things out very quickly last spring, and that situation proved temporary, thank goodness. But we had lots of dislocations throughout the year. Prices shot dramatically higher in the late spring, early summer, as supplies had adjusted a little bit, and people were stocking up on things that they could buy at the stores. And of course, we had lots of giveaway programs that made us use more cheese and some other products than would have otherwise been the case. So it drove up the price of the milk that's used for making cheese as Class 3 milk in the green line. At the same time, demand for butter and powder was not consistent with that. And so those prices stayed pretty low throughout the remaining months of 2020. As we look forward, we expect that we're probably going to have some additional cheese processing capacity come online in the months and years to come. That should help us increase cheese production and probably help bring the prices for the various types of classes of milk back in normal relationship with each other. On the government program side of things, again, we mentioned already the very large payments that were made in 2018, 2019, especially 2020. In fiscal year basis, in fiscal year 21, the fiscal year we're currently in, may well have a record level of spending on the programs that we keep track of that are involved with payments to farmers or other support to the farm sector, with those big payments for CFAP and for other temporary programs. As we look ahead, right now we don't have any assumption about future ad hoc programs. So those all disappear starting in fiscal year 22. And we go back to a more normal level of spending on farm and farm related programs of about $23 billion per year. I should note that this projections do not include the reconciliation bill that was just approved. So it does not include the loan forgiveness for disadvantaged producers, nor some of the other provisions of that bill that were approved a couple weeks ago. Net farm income, much to many of our surprises, turned out to be pretty good in 2020 when all was said and done. The combination of incredibly large government payments, the $46 billion we mentioned earlier in calendar year 2020, plus much higher prices for crops in particular at the end of the year, led to a far higher farm income figure than had been anticipated previously, $121 billion, not far from the $123 billion record that was set just back in 2013 in nominal terms. For 2021, we do expect a slight drop in net farm income as $25 billion additional crop and livestock receipts due to higher prices is offset by $22 billion in lower government payments and $13 billion of additional production expenses. If there's no new temporary programs approved for the future, we would probably see a further decline in farm income in 2021, or 2022, I should say, but then relatively stable in nominal terms thereafter. Note that even with the decline that occurs this year and again in 2022, we still have net farm income levels well above the levels that were common between 2015 and 2019. This combination results in a rare situation where we might see a bit of a dip in the debt to asset ratio facing the farm sector in 2021. We expect about a 5% increase in farm asset values this year in response to the good income picture and lower interest rates. So that increases assets quite a bit. So even though debts are also likely to increase this year, the pace of increase is larger on the asset side. And so the debt asset ratio drops for the first time since 2012 this year in our projections. And again, finally, on the food consumer side of things, we saw, again, we talked about at the beginning of this, higher prices for consumers for meats in particular, but a number of other products as well, especially for what people purchased at grocery stores to eat at home. Prices for food away from home, of course, there wasn't much away from home eating in the second quarter of 2020. That started to come back at the end of the year, and some of the higher commodity prices did feed through to higher prices for food away from home by the end of 2020. But as we look into 2021 and beyond, we expect that overall food inflation is likely to drop back to the more normal level of about 2% per year as things get back to more normal in the food sector in general. So I'd like to thank you all for this opportunity this morning. I'll be happy to take some questions from you all. Here's our FAPRI team. Should note that a couple of the folks in that picture are no longer working for FAPRI. In the far left there is Scott Gilt, who's now with the American Soybean Association. And in front of him is Seth Meyer, who's now USDA's chief economist. We miss Seth a lot, but we're looking forward to him being part of our program next week, when on Friday of next week, we're going to have our annual WOMAC conference. This year, of course, given the circumstances, it'll be an online conference from 9 to 11 a.m. on Friday of next week. And you're welcome to register for that free event and hear from us about the outlook, not just for the things we talked about this morning, but also for Missouri farm income, and a panel that will be moderated by Tyne Morgan of U.S. Farm Report. So with that, thank you all very much, and thanks for the opportunity. Happy to take your questions.
Thank you, Pat, for presenting. And like Pat mentioned, if you do have a question, please go ahead and submit that in the chat screen, or you can send me an email at roacham@missouri.edu. To get us started, Pat, you kind of alluded to ASF situation in China, but there's a question about, is there a resurgence of ASF in China, or is it just an isolated outbreak here and there?
I think that's what we're all trying to figure out right now. It appears to be relatively small scale so far from the press reports, but there's also lots of questions about it. We always don't have the highest level of trust in what we hear out of China. So there's concerns that this could be worse than perhaps has been portrayed so far.
Sure. Another question related to China would be that we had strong trade in recent months, and that's been really motivated by Chinese trade, and that's also caused grain prices to rally. So what's the status of the notable U.S.-China trade agreement that was signed last year? Is that contributing to this purchase from China, or are there other factors at play here? Can you talk a little about that?
Yeah, there's lots of factors involved in this, and certainly last year's agreement is probably part of the story. China had in place a lot of barriers to U.S. trade. Some of those have been resolved. There's been a number of changes in Chinese trading practice that should provide some longer-term benefits to our trade with that country. However, it's also important to note that while exports to China were up dramatically in 2020 from the previous year, we still fell well short of the target that had been established in that agreement. For calendar year 2021, that target's even higher, $43.5 billion by some people's reckoning of how to interpret the agreement, which would be something close to double the level of trade we saw during fiscal year 2020. And while we would expect there to be another increase in calendar year 2021 sales, we would be very surprised if we were able to get to that kind of a level in exports of U.S. products to China. The positives being, again, China's importing roughly 3 times as much corn this year as they ever have before. And this may sound a bit strange, but it's actually good that they're buying not just from us, but buying from other countries as well, because that means that it's not just diverting trade from one country to another, but rather it's increasing the overall pie. And it means that there's more demand in the world in general, and that's pushed up the prices for not just corn, but soybeans and many other crops as well.
So what are some of the other countries then that have increased their imports of grain products recently?
So it's not so much there's been big increases in most other countries, but we haven't seen much of an erosion, which has probably been a positive in light of the big increase in prices. So the fact that we've been able to hold our own, the quantity sold to most other countries in spite of higher prices mean that the underlying demand must be relatively strong.
Great, thank you for that. I want to switch over to ethanol and have a short discussion about it. The baseline projects that ethanol use in 2021 will not reach the pre-COVID levels. So to what extent is lower ethanol production and use a long-term issue for the industry to address?
Yeah, there's just tons of questions where we're going on the ethanol front, and it's a combination of driving habits. It's a combination along with policy changes that may or may not occur in front of us. There's a big fight going on right now about a number of issues on ethanol policy, including whether or not there should be the same number of small refinery exemptions offered as has been the case in the recent past. The market right now seems to be assuming there will not be as many offered this year as was the case in 2018 and 2019. If that's the case, that means a bit more ethanol consumption will be required under the current rules. Looking forward longer term, there will be a chance to reset the table, if you will, on ethanol and biofuel policy in general in 2022 by the Environmental Protection Agency, given rules set up by the bill passed way back in 2007. So how the new administration chooses to approach that question is a big question mark as well.
Great. I want to skip to net farm income now. One of the factors that was contributing to the projected decrease in net farm income for 2021 was production cost increases. What particular inputs have been increasing in cost?
So with higher corn and soybean meal prices, that means higher feed costs to livestock producers. That's been the single largest increase we've seen, at least in our projections. Fertilizer costs were expected to be up by us, and fertilizer and feed combined were more than half of the total increase that we had been projecting. Now, since we did this in January, things have probably gotten even more extreme in terms of production cost increases. Feed costs even higher than we might have guessed a couple months ago. Fertilizer costs right now seem to be shooting up higher at a very dramatic pace. We've seen very high quotes for anhydrous fertilizer, for example, just in the last couple weeks here. And then fuel costs, of course, are a bit higher than we would have guessed, as well as oil prices and all the associated fuel prices have been even higher than anticipated previously. So that combination does mean yes, we see a big increase in receipts this year, farmers are also paying more for the inputs that they buy.
Sure. One topic that you didn't cover in your presentation today, but it's in the full Outlook publication, is farm real estate values, and they really have surged in the past decade. So to what extent might these higher values cause structural changes in agriculture? For instance, maybe some older farmers are looking to get out, or how challenging will it be for beginning farmers to access land with those higher prices?
So it's a relatively small amount of land that actually is marketed in a given year. It's a very slow turnover in agricultural land markets. And so it's because it's a thin market, the decisions by folks at the margin can make a big difference on prices. We have seen some reports of higher land prices around this part of the country in the last few months, and we are projecting, as I said earlier, a 5% increase in overall land values for the country as a whole. Those higher land values, of course, are a mixed blessing. If you're someone who owns those assets, that's a big positive for your net assets that you control. On the other hand, if you're someone trying to get into farming, it means that, well, it's probably a positive sign that people are optimistic about the future. It does mean it's going to be more difficult for you to get that initial loan, given the higher cost of the land that you'd be wanting to purchase. Offsetting, of course, are low interest rates that we have right now that have helped make things maybe a little more tolerable than they would have been had we had the interest rates we had even a couple of years ago.
Right. I want to talk about climate because that's been a big topic in federal policy. Since Biden took office, he's talked a lot about environmental and climate change initiatives, and so has his administration. So to what extent has FAPRI considered possible climate-related initiative payments as part of farm income?
We've already had some discussion with folks in DC about analysis we might do down the road about this. And certainly it will depend on the nature of those policies and how they operate and what sort of cost farmers might incur in order to be able to obtain the benefits of those programs. But we fully expect that we're going to see more debate about this in the weeks and months to come. We had a good discussion with people at USDA just very recently, talking about the need for us not to talk about just 10-year outlooks for the farm economy, but something that extends much farther into the future, to be able to evaluate not just climate effects, but also the effects of policies that may affect the sector in general as we try to address climate concerns.
Great. I want to close on a question about the next farm bill. It seems like it's quite a ways away, 2023, but it'll be here before you know it. So what are policymakers already doing to plan for that bill, and how will this past year's experience shape their farm bill priorities?
So one thing you might ask is, why did we have to have these very large ad hoc programs put together the last several years? The MFP program to deal with trade concerns and the CFAP program and other associated programs to deal with the coronavirus. Why don't we just have in place safety net programs that will handle these sorts of things automatically? Now, one argument is, well, these are kind of out of the blue, once in 1,000 year sort of things, and so you shouldn't make plans around something that's going to be like a meteor strike. But on the other hand, people say, no, wait a second, maybe we should have a better safety net in place so we don't need to pull these things together in such short order. So I fully expect we're going to have a debate about that as we go forward. A challenge is going to be on the budget. We decided as a country that it was okay in 2018, 2019, and 2020 to increase federal spending quite a bit to address these concerns. There's or at least some people looking forward who'd like to see a tighter rein on budgetary choices in the future. So if we're going, some would say if we're going to try to create something new here, do we have to cut something else off instead? And what kind of trade-offs are we going to be talking about to make that possible?
Sure. Well, thank you, Pat, for presenting today and for taking our questions. And thank you to our audience for joining us. When you exit Zoom, you'll see a post-webinar survey will load in your browser. Please consider responding, as we'll use the results to improve the webinar experience and also brainstorm future webinar topics. Again, you should receive a recorded copy of today's webinar via your email within about a day from now, and we'll also include the slides and links to the WOMAT conference or the FAPRI Outlook publication. You can join us for our next webinar on Wednesday, March 31st. Dr. Nicholas Kalat-Zandonakis will speak about genome editing's potential impact on U.S. agriculture. So again, thank you for joining us, and I hope you have a great Wednesday.